very good afternoon. So, what are we going to look at today? We're going to look at again, uh, first 10 minutes. You have the timetable of ours, right? This is our timetable, right? 5:30 to 5:40. There'll be a recap where I'll ask questions. 5:40 to 6:55, I will teach. First round of teaching. 6:55 to 7:05, there will be a break. 7:05 to 8:20, I will teach again. In 8:20 to 8:30, there will be a review. Okay. Now, if I have to kind of ask you what we did, who can tell me what an exceptional item is? Who can tell me? How many of you, is there anybody who's attending this class, any of my class for the first time? Hitanshu, Samantha, have you attended my class before? You only attended the demo. What about the class? It's uploaded on the LMS. Did you watch that? What about others? Satakshi, I've seen. Teerth, I think so. You were there. Did you watch the previous video, Samantha? Not yet. Please make sure you do. It's uploaded on the LMS. So I hope what we looked at in the previous class was clear, easy to understand, easy to kind of go through, right? I hope all of you are studying, right? Now what we are going to do is, again, I'm going to recap is basically me asking questions. But if there is going to be silence in the group, then unfortunately I'll not be able to help much, because we are doing our best. Best is up to you, right? So, Tatakshi, can you tell me whether purchase price of land will be included in the cost of the asset, in the capital? Will it be capitalized? Will you capitalize the purchase price of land? Purchase price of land, will it be capitalized? Hitanshu, you say land cannot be capitalized. But without buying the land, again, please make sure, guys, that all these recordings that you are watching, you are doing it well, right? Purchase price of land, I mentioned that when you buy an asset, you see if it is, the purchasing cost has to be capitalized, because obviously without purchasing it, you cannot use it, you cannot own it. So any cost incurred in purchasing, bringing it to usable condition, and bringing it to under your ownership, any of those costs will be capitalized, right? So this is extremely important, right? And we looked at subsequent measure and all of that. But again, for whatever reason, I feel that it is very important that you go through, study after each class. Otherwise, there's no point. Illustration 3, illustration 4. Major inspection overhaul. We did this illustration also. And now we're continuing. We also looked at illustration 5, which is this illustration. Today, I'm going to continue from revaluation of non-current assets. No, notes will not be uploaded. This is lecture notes. This is not school. Already I'm not getting responses from everybody. I want you to sit, write down lecture notes, sit with a calculator. Please be alert in class. You are supposed to sit with a calculator, pen, notebook, everything. Revaluation of non-current assets is the first thing that we're going to look at today. We did mention this. You're supposed to, in the circular, you're supposed to sit with notes, pen, calculator, all this. Basic writing you have to do. I will teach, I will write down here. You have to at least write that down, or at least copy it. That's the only thing you have to do. See it and copy it. Now again, I told you what IAS 16 is. IAS 16 is a friend for you. IAS 16, remember I told you what IAS is. It's a friend. It is coming and telling you how to do financial reporting. IAS is coming and telling you how to do financial reporting. And in that specifically and exclusively, IAS 16 has a rule. In PPE, property, plant, equipment. IAS 16. Right? According to IAS 16, you have to know two models of revaluing non-current assets. The first is the cost model, which is the easiest model, which we will look at through an example. An entity revalues its buildings and decides to incorporate the revaluation into its financial statements. Extract from the statement of financial position at 31st December 2027 looks like this. The building costed 1,200,000, out of which depreciation was 144,000. So as of now, the carrying amount of the building is 1,056,000. So it is like saying that I bought a shoe. The shoe was bought for 1,800 rupees. But due to wear and tear, there was a drop in the value of the shoe, and that is known as depreciation. The shoe depreciated. Now, again, this is an example. Shoe, just to make things simple, asset has a value of 1,800, and there was a wear and tear, a drop in the value of wear and tear of 300 rupees, meaning as of now, the amount at which this asset is valued is 1,500. But you can revalue the asset. Generally, it will so happen in terms of property, for example. Think of how property could revalue. Again, you have a building. Okay, this is your building. As of now, the building is worth 8 crores. But will it always be 8 crores? No. Maybe there is a big mall constructed in front of the building, huge mall. This is a mall. So because of that development, the building's value has increased. That is what is revaluation. Right? So according to this question, what you're able to see is the carrying amount of the building is 1,056,000, but the building itself has been revalued. The building itself, there is a new value to the building of 1,400,000, and it says that the useful life of the building is how much? 40 years. So there is basically a new value to the building, right? And show the relevant extracts from the financial statement. So basically you will show extract. Extract means what? Part. You will not show the entire financial statement, Samantha. You will show parts. For example, show extract or parts from the statement of financial position. Show extracts or parts from the statement of profit or loss and other comprehensive income and statement of changes in equity. Right? So what is happening here is this. Okay, the carrying amount of the building was only 1,056,000. See this 1,056,000, but now it has been revalued on 1st of Jan to 1,400,000. So the revalued amount is 1,400,000. Is 1,400,000. Therefore, how much is the change or the excess value that we have gained. How much value has the building gained, guys? Can you calculate and tell? Right now it is 1,056,000, but it is revalued to 1,400,000. So what is the gain in the value? 344,000, right? So the revaluation is worth 344,000. So there is a revaluation of is 344,000. Why? Because it has jumped. The value of the building has jumped from 156,000 to 1 million, sorry, not 156, 1,056,000 to 1,400,000. Therefore, there was a revaluation of 344,000. So this is one piece of information that you need to know, which I'm putting in black. One piece of information that you need to know. Now, the next piece of information that you need to know is, again, now the value, the revalued amount is how much? 1,400,000. This is the revalued amount, right? So now we will, as usual, depreciate. Again, Samantha, what is depreciation? Depreciation is the drop in the value of an asset due to wear and tear. Building, will it get old, Samantha? Will it get worn out? Yes. Building will definitely, there will be wear and tear. So the building has a value of 1.4 million and a life of 40 years. So the wear and tear will happen for a period of 40 years. So think about it. The wear and tear or depreciation will be, the building is worth 1,400,000. It will depreciate over a period of 40 years. So the yearly depreciation will be how much? 35,000. Again, let me check, because I'm not doing the calculation. I'm leaving it to you guys. Something you have to do. Everything will not be put on a silver platter. Calculations you will have to do. 35,000 is the depreciation, right? So this is the yearly annual depreciation, right? So think about it. The question wants to know, show the relevant extracts from 31st of December 2028, right? This was the value of the asset on 1st of Jan 2028. This was the value of the asset on 1st of Jan 2028. Then I said the yearly depreciation, that is every year there will be a depreciation of 35,000 and the building is worth 1.5 million. So after 1 year, yes, it started at 1,400,000, but every year it is depreciating by 35,000. So after 1 year, the carrying amount on 31st of December 2028 will be, again, there will be 1 years of depreciation that is charged, or there will be a drop in the value of the asset by 35,000. So the building was worth 1.4 million at the start of the year, but during the year it dropped, the value dropped by 35,000. So at the end of the year, how much will be the value of the asset? I will need answers fast. 1,365,000. Therefore, at the end of the year, the value of the asset is 1,365,000, which can then be reflected in the statement of financial position. Right? So now I have this piece of information, whatever is in black, I have these pieces of information which I can reflect in the various financial statements. For example, in the statement of financial position for 2028 ending, I will say that the building is worth 1,365,000. right? So I will say land and buildings have a value of 1,365,000. This is after taking into consideration that the property was revalued to 1.4 million at the beginning of the year. And during the year, there was a drop in the value of 35,000. So at the end of the year, the value of the asset is 1,365,000. So you are showing this in the statement of financial position. Is this clear to everybody? I need everybody to type. If you have doubts, now is the time to ask. Please type. Right? Now, another piece of information. Remember, in the previous class, I showed you the format of the statement of financial position. In the statement of financial position, go back to my index. Here I showed you how the statement of financial position looks. Right? So in the statement of financial position, apart from the land and buildings, apart from non-current assets, you also have current assets. And apart from that, you also have what? You also have equity. Anyway, I'll come to that shortly. This is statement of financial position. The next statement we will create is statement of profit or loss. Remember, all the expenses need to go to profit or loss. All the income needs to go to profit or loss. Right? All the expenses and all the income needs to go to profit or loss. And remember, I told you in the previous class, yearly depreciation is an expense. It is a drop in the value of the asset. Therefore, in the statement of profit or loss, the depreciation expense needs to be mentioned. 35,000 was the depreciation expense. And any income or any gain also has to go to the statement of profit or loss. So I'm just putting all the headings in blue. Statement of financial position, statement of profit or loss. Any income also will land in the statement of profit or loss, right? And remember, go back to this piece of information. The building initially had a value of only 1,056,000. Imagine you have a property worth 1,056,000 and suddenly somebody builds a big multinational company in front of your house, because of which the value of your house now has become 1,400,000. So there is a gain, right? There is a gain of 344,000 gain on revaluation. This is something your property has increased in value by 344,000. Therefore, the gain on revaluation is an income which will also be reflected in the statement of profit or loss. How much is the gain on revaluation? 344,000. So any income or expense we're putting in the statement of profit or loss as we had seen in the previous class. And in this specific class, we are saying that there is one expense in 2028, and that expense is the yearly depreciation of 35,000. And there is one income in 2028, and that is this gain on revaluation. So both these things, annual depreciation and gain on revaluation, are landing under the statement of profit or loss. I hope that is clear, right? Then what do we look at? We look at the gain, 344,000. Again, Satakshi, your building value has increased by 344,000. You are happy about this, Satakshi? or unhappy? You're happy? Very good. It's a gain. But tell me this one thing. You did not sell the building. Only the value of the building increased. This question is to everybody. The value of your building has increased, but will you get any cash? 344,000. Will somebody come and tell you, look, today the value of your building increased by 344, take this cash? Will anybody come and tell you this? Everybody? Teerth said no. Satakshi said no. Quickly, everyone. Samantha? Mubashira? No. So this gain is an unrealized gain. Imagine if you have a house, the house is worth 1 lakh. If suddenly the value increases and the house becomes worth 1.2 lakh, yes, there is a gain, but it is an unrealized gain. What do I mean by unrealized gain? You don't get that extra 20 lakhs. It is just there in the building's value, but you don't actually get it. You understand? So this gain of 344,000 isn't really realized, right? It is a gain which will be given to shareholders if at all we are selling the building or the business. It is not realized today. We do not get that 344,000 today. We will get it when we sell it. So it is not realized by us yet. Realized means we have not got it yet. It is not given to shareholders yet. And any amount which belongs to shareholders will fall under the category of what? In the statement of financial position, it falls under the category of equity. Equity is anything that belongs to the owners. You remember I told this in the last class. Anything that belongs to the owners. And this 344,000, obviously, there is a gain in the value of the property and the property belongs to the owner. So this 344,000 also belongs to the owners. Therefore, you will also put it under equity as a revaluation surplus. So revaluation surplus, you will put 344,000. Right? Guys, have a look at this. I've put statement of financial position, 2 things, and I've put statement of profit or loss also, 2 things. Both the headings are in blue and under that the content of it is in green. Just see if there's a problem. Let me know if you don't understand where we get a specific number from. Anybody, any problems with these 2 headings, with these 2 financial statements? Anyone issues? Yes or no question? Quickly time. Only one person is answering fast. Satakshi. Mubashira, okay. No problems. The third financial statement that we need to put things into is the statement of changes in equity. Again, Samantha, this was done in the previous class. So it's essential that you watch the recording. Statement of changes in equity. See, in my index of the previous class, it's there. So again, here, what will happen is statement of changes in equity. Remember, anything that belongs to the owners will fall in the category of equity. And here in this specific question, this gain in revaluation is actually equity. This revaluation surplus I just told you just now. Who does it belong to? It belongs to the owners. It will come under equity. And that is why it is also necessary to put this 344,000 in the statement of changes in equity. So you will say revaluation gain 344,000 because this gain belongs to the owners. And that is why it needs to go as a revaluation surplus under the statement of changes in equity. So basically, in this question, I have put three headings: statement of financial position, statement of profit or loss, and statement of changes in equity.
It's 6
If
o'clock.
anybody has a problem with where we got a specific number from or why we are putting a specific number in a specific financial statement, now is the time to ask. Best time to ask is now. When do we consider excess depreciation? Which depreciation are we talking about, Samantha? Are we talking about this depreciation that we've taken into consideration? Are we talking about this depreciation? Let me know what you mean by when do we take excess depreciation. See, this again, just clarify so I'll be able to clear it better. Okay, let me just, from what I have understood from your question, let me just clarify. Meanwhile, you can type also. But Samantha, history says that the building had originally costed you 1,200,000. And in the past so many years, there was a depreciation of 144,000. And we said that after that depreciation, value of this building is 1,056,000. That is history, past. Today, when I opened my book, the building was already valued at 1,056,000. And today, I got the good news. I got a call and I got the good news that, oh, my building has been revalued. So today, I got this good news. So we said that the building is now having a gain of 344,000, and now the value of the building is 1,400,000. So forget the old depreciation. Old story is history, and I have already taken the carrying amount. Today, I got this good news that the building is revalued to 1.4 million, and now today onwards, I will start my depreciation afresh. What do I mean by afresh? Now they are saying that my building is valued at 1.4 million and there is a life of 40 years. Therefore, for this first year, obviously, Samantha, if 1.4 million is depreciated over 40 years, yearly depreciation will be 35,000. So this year's depreciation, Samantha, that's why I put annual depreciation. This year's depreciation is 35,000, which I have depreciated, and I said by the end of this year, the carrying amount of the building is 365,000. Now, the other depreciation, you will not depreciate now. Second year's, this 35,000 is only depreciation for this year. The year's depreciation, you will depreciate as and when the years pass. Not now. Samantha, is this clear? With that, this question is over. Right? So, going back, as I mentioned, the cost model of revaluation is simply taking the cost of the asset, like we did here, taking the depreciation, taking the carrying amount of the asset, and then simply revaluing it to the new value, which I did in this sum. What did I do in this sum? I had the old value, and then I simply revalued the building to the new value, as simple as that. And then I will depreciate as usual. That is the cost model. So property, plant, equipment is should be valued at cost less accumulated depreciation, which is what I had done here. Here also it was cost minus accumulated depreciation. And then after that also, the new value minus the depreciation. So one way of revaluing your asset is cost model. IAS 16 allows you to use the cost model. The other way is the revaluation model. Okay, which is what we did over here. You revalued the asset to a new value and then deducting all the accumulated depreciation. So two methods. Cost method is basically where cost model is basically where you will take the original cost and you will deduct the accumulated depreciation and value the asset based on that. Revaluation model is basically where what I did over here, this part. I revalued the asset to a new value and then continued depreciation as usual. That is the revaluation model. So cost model is where you will value the asset at the original cost and then take the depreciation and value the asset based on that. Revaluation model is what I have done here. Yes, there was the original carrying amount, but I revalued it to the new amount. And then when I continue depreciating, that is the revaluation model. So I hope both cost model and revaluation model are clear to everybody. IAS 16 tells you that you can subsequently measure your asset using either of the two. Both are allowed. Cost model is also allowed. Revaluation model is also allowed. Read the cost model. It says property, plant, equipment should be valued at the original cost less accumulated depreciation. Revaluation model says property, plant, equipment may be carried at a revalued amount less the later depreciation that is charged after the revaluation. See here, after the revaluation, there was again a new depreciation charge that was calculated. Right? I hope this is clear. Right? Again, you don't need to, guys, please, some people sit and ask me, can you explain to me these steps? It's okay as long as you're understanding the steps. I don't mind, but please don't sit. It's very sad to see. I don't know, but it is very sad to see that many people, even the ones who've taken coaching, they come and ask me, I'm learning, remembering the steps. Nobody in the ACCA exam is going to ask you to list down steps. What are this? Is not school. What are the 3 steps of accounting for you? Nobody asks you that way. So as long as you understand the steps, it's enough. And I've already explained to you what those steps are. But we can recap on this. Step 1, restate the assets cost to the new valuation. I did that. I restated it to the new valuation. Eliminate existing accumulated depreciation from the asset. We didn't have to do that here, but again, we kind of automatically, it did happen, right? I revalued the asset to the new value 1.4 million. Right? And then I carried on to depreciate and then show the total increase in other comprehensive income. We did that. This total increase, we showed it in the statement of profit or loss and other comprehensive income. Right? So I hope illustration 6 is clear to everybody. Right? Now, again, depreciation of revalued assets. We've already done this in illustration 6. But again, there would be a slight difference or a slight change, which I want you to be comfortable with and know. Okay. And look at test your understanding 2. Test your understanding 2 says on 1st of April 2028, the fair value of Zoo's property was 100,000 with a remaining life of 20 years. Zoo's policy is to revalue its property at each year end. At 31st March 2029, the property was valued at 86,000. The balance on the revaluation surplus at 1st April 2028 was 20,000, which relates entirely to the property. Okay. Zoo does not make, let's just look at the question. Prepare extracts of Zoo's financial statements for the year ended 31st March 2029. So again, what are you expected? What you are expected is this. This. You need to make extracts. Keep this saying the profit is 9,000. I don't know. I'll have to calculate that. Okay. We need the reval. We need the statement of financial position. I need the statement of profit or loss. And I need the statement of changes in equity. These are the 3 things I want technically. Okay. And how do we deal with this? Obviously, if you want the statement of financial position, you need to know what is the value of the property, which we will calculate, or maybe we will have it in the question. Right? So let's look at the question. The question says that on 1st April, the fair value of Zoo's property was 100,000, 2028. Right? In the following year, the property was valued at 86,000. So Zoo's policy is to revalue the property at each year. So at 31st March 2029, the property was valued at 86,000. So again, here, what are the steps? First of all, let's try to calculate the yearly depreciation when we start. When I started, guys, the property was worth 100,000, and obviously the depreciation, the question clearly mentions that the life is 20 years. So you will depreciate this property over a span of 20 years. So 100,000 divided by 20 is how much? I need answers fast because I don't want to scroll to the answer and keep checking because that will take a lot of my time. Very good, Samantha. 5,000. So depreciation originally is 5,000. Life easy. Right? So we have this as an expense. So whatever is an expense, I'm highlighting it in red so you know where to put it. Then what is the next thing that we will look at? There was a revaluation made. Right? Think about it. On 31st of March 2029, the property was valued at 86,000. So what does this mean? No, Sthir, there will be no revaluation surplus, I doubt. Because, see, 2028 April, the property is worth 100,000. If the property is worth 100,000, then at the end of the year, that is March 2029, the property should have a carrying amount technically of 95,000. Why? 100,000, depreciation is 5,000. So the carrying amount in 2029 is supposed to be 95,000. It is supposed to be 95,000, but the property was valued on March 2029 as 86,000. So it is revalued to 95. It's supposed to be 95,000, but it has been revalued to 86,000. So it's like saying that you have a building, you think it is worth 95 rupees. But somebody comes and says, no, now the new value of it is only 86. You will be unhappy because you've lost money. So remember, there's a loss, not a surplus. There's a loss on revaluation because we've revalued the difference between 95,000 and 86,000 is lost. That would not be right here. Remember, it's very simple. Don't complicate your life. As per what we were depreciating, depreciation was supposed to be 5,000. So from 100,000, if we depreciate 5,000, the carrying amount is 95,000. But today I got a call from my friend who said that your property is worth 86,000. So it means there is a drop in the value from 95,000 to 86,000. There's a drop in the value. And there's a drop of how much? Yes. There's a drop in the value of, again, think about it. There's a loss on revaluation of 9,000. I will come to that part, Teeth, which you are putting. But the loss on revaluation is 9,000. This is a loss. Again, remember, it's an expense. We're losing it. So anything we are losing, I'm putting in red. It's like bleeding. We are bleeding. Right? So now that we have these figures, whatever expenses we had, that will land in the statement of profit or loss. We know because I told you in the beginning itself, statement of profit or loss will have expenses. So depreciation, 5,000. It's an expense. Revaluation loss, 9,000. It's an expense. So statement of profit or loss, I hope, is over. Then what happens? We also look at the statement of changes in equity. What do I mean by that? Look at this. The balance on the surplus, revaluation surplus at 1st of April 2028 was 20,000. What do I mean by this? Don't panic. What do I mean by this is when I opened the statement of profit or loss, I already had a revaluation surplus of 20,000. This has nothing to do with what has happened now. When I opened the book, there was already a surplus of 9,000, just like how we had a surplus in the previous question of 344,000. Same way, when I opened the book, there was a surplus of 20,000. But now we have realized that there is a drop because of revaluation. See here, there is a loss because of revaluation. This is a revaluation loss, which will reduce this surplus. It's like, I'll give you an analogy. In your bank account, you have savings of 20,000. But if suppose somebody comes and spends your money, just give me a second. Somebody comes and spends 9,000 rupees. There's a drop in your savings. Right? So there's a drop. 9,000 rupees you lost somewhere. So your savings will drop. Same way, when you opened the day, when you started the day, there was a surplus of 20,000 because of revaluation. But now, because of revaluation, there is a drop in revaluation. So what we will do is, again, this will be a loss. There will be a drop in the revaluation. So drop is of 9,000. So the new balance of statement of changes in equity will be only 11,000. Tirth, you understood? So we have the statement of profit or loss. We have the statement of changes in equity. So statement of profit or loss, statement of changes in equity, and statement of financial position. What is it? How will I do statement of financial position? In the statement of financial position, you will have to show the value of the asset. Right? And remember, now after revaluation, the new value of the asset is only 86,000. So you will be lying in the financial statements if you show 95,000. Because remember, you got the call today. They said the value of the property is only 86. So in the statement of financial position, you will say the property has a value of 86,000. And what will you do? Remember, in the statement of financial position, there is also a heading known as equity. Under equity, any revaluation surplus needs to be shown. And see, the revaluation surplus was 20,000. But now there is a drop of 9,000. So we have a new revaluation surplus of only 11,000. There is a drop in the revaluation surplus. So that also under equity heading, under revaluation surplus, needs to be shown in the statement of financial position. How much is the revaluation surplus? It is only 11,000. Why? Because there is a drop. So these are the three headings, guys. Where did I get this 86,000 from? Again, we are preparing it for 2029, and we got to know that in 2029, the property has been revalued to 86,000. So we are honestly showing it on the statement of financial position. Then, where did we get this revaluation surplus amount from? Again, remember, there was a revaluation surplus of 20,000. See this, follow my cursor. There was a revaluation surplus of 20,000, but that revaluation surplus has dropped. Yes, there was 20,000, but there is a drop in that. Why? Because think about it, the actual value was supposed to be 95,000 because of this reason. Property originally costed 100,000, there was a depreciation of 5,000. So actually there was supposed to be a value of 95,000, But today I got a call and somebody told me that the property is worth only 86,000. So there is a loss because of revaluation. That loss is taken into consideration. So yes, you had a surplus, but there is a loss. So the new revaluation surplus is 20,000 minus 9,000, 11,000. So this 11,000 is coming from there. Statement of profit or loss, again, this what I've put in red is coming in the statement of profit or loss. Just see this calculation. Whatever is in red is going to the statement of profit or loss. So with that, guys, test your understanding 2 has come to an end. So is our understanding for test your understanding 2 strong? Everybody clear or somebody has a doubt? Again, I'll show you the 3 headings. You can ask me if there's any problem. Clear what about item 2? I didn't get you, Samantha. What item 2? The second part of the question? Are we talking about this? No, I haven't come to that. Show how I'm asking what I've completed. This question, test your understanding to what I've completed. I hope everybody is clear with it. Now, part 2 of the question is saying, how would the accounting be different if the opening revaluation surplus did not exist? Now, again, remember, this revaluation surplus, the question is talking about. Imagine in your bank account, there was no savings at all. So your bank account will go minus 9,000, negative 9,000, correct? And that is what will happen if that opening revaluation surplus did not exist. If the opening revaluation surplus did not exist, this much would be as it is. There would be no difference. Property 100,000, there was a yearly depreciation of 5,000, carrying amount was 95,000. Property got revalued to 86,000, so there's a loss of. There would be no difference. But because there was no revaluation surplus, go to this part. In this question, there was already a revaluation surplus of 20,000. So from that, we deducted 9,000 and we still have a revaluation surplus of 11,000. But part 2 of this question is saying, what if there was no revaluation surplus? Then we would be in problem. This revaluation loss would, first of all, there would be no revaluation surplus. There would be a revaluation loss. There would be no surplus. And because it's costing us money, we are bleeding again. See, it's costing us. Remember, whatever is costing us, we are bleeding from there. It's in red. And I told you, anything we are bleeding from, anything in red, we are losing. And it's an expense. And where do you think it will go? Anything in red, anything we are bleeding, where is it going? Anything that's costing us? I mentioned. Where is it going? Where is it going? I mentioned whatever is in red, whatever is in expense, it goes to statement of profit or loss. See, I did that. Whatever was in red, I told you we are bleeding. It's an expense, it's a cost. So I told you it's going to P&L. See, this 5,000 also I put to P&L. This 9,000 also I put in P&L. right? So in this case, this 9,000 will just be a loss that we will incur. It will be like an impairment expense. Basically, if this 20,000 did not exist, then we would have no revaluation surplus. As simple as that. I hope test your understanding 2 is clear. Please type it fast. Yes or no? Why only 2 have typed? What about the others? Is it okay? Not okay. Simple yes or no question. Clear or no? There is Kenny, there's Itanshu, there's Priyanshu. Nityashri. Quickly. Go through everything. I'll give you 2 minutes. Nityashri, clear or no? Yes means what? Okay. Let's look at test your understanding 2 we saw. Test your understanding 3 we saw. Depreciation of revalued asset. Test your understanding 3. Again, show the effects of the above on the financial statements. Again, we have to show extracts. Basically, statement of financial position, statement of profit or loss, statement of changes in equity. Right? We do. An entity revalued its land and buildings at the start of the year to 60 million. Okay. Out of which 15 million was for land. The property costed 30 million, 6 million for the land, 10 years prior to revaluation. The total expected useful life of 40 years remains unchanged. The entity's policy is to make an annual transfer of realized amounts to retained earnings. What is this annual transfer of realized amounts? There is a choice. I will come back to this. Okay. But show the above effects. How will we simplify our life? Let's always agree to start with calculating the depreciation. Okay. Always we'll agree to calculate the depreciation. And again, because there are 2 parts, there is land, there are 2 assets technically. There's land and there's building. Land costed how much? Land costed 6 million. How many years ago? How do I know land costed 6 million? Let's see. Land costed 6 million and building costed how much? From 30 million, if 6 million land costed, building costed 24 million. This is the starting of the story. 10 years ago, this was the story. So we are going recap. Flashback. 10 years ago, land was 6 million, building was 24 million. Right? After that, we will depreciate. Because in 10 years, obviously, there will be wear and tear. But remember, land, suppose this is a piece of land I have. How many years we are using land from? The land you are on right now. I'm not talking about building. The land you are sitting on right now. The land on which your building is there from how many years? Millions, billions, I don't know. But if you demolish the building, that land is as good as new. So the thing with land is land will not get worn out. Building will get old, building will become broken, building will, all that will happen with the building. But land will not get worn out. If you demolish the building, the land is as good as new. So there is no depreciation on land. Because land doesn't depreciate because there's no wear and tear of land. Right? So going over here, there will be no calculation of depreciation for this land. No calculation of depreciation for this land. Right? So what are we doing? Think about it. Land, there will be no depreciation. From 6 million, directly the land is now becoming worth 15 million. So now it costed 6 million. The revalued amount is 15 million. So there was a gain of how much? There was a gain of how much? 9 million, right? So the revaluation gain for land is 9 million. What about building? Let's do building. Building is something that will get old, that will get worn out, that will, wear and tear will happen for building. Right? So building, what will happen is there will be depreciation. And the question clearly tells that the useful life of the building is how many years? 40 years. So building, there will be a depreciation. Think about it. The building costed 24 million. And for the first 10 years, see, we are evaluating the first 10 years. Think about it. If the building has a value of 24 million and will have a life of 40 years, how much will be the annual depreciation? 24 million divided by 40. How much is it? How much is 24 million divided by 40? Very good, Samantha. It's 600,000. 600,000. So if 1 year depreciation is 600,000, 10-year depreciation is how much? Because remember, we are doing this calculation after 10 years. So if 1 year is 600,000, 10 years will be 6 million. So this is the calculation only. Okay, so the black part is just the calculation. It is not the answer. It's just the calculation to get the 10-year depreciation. Right? So 6 million will be the 10-year depreciation. So how much would be the carrying amount of the building? From 24 million, if 6 million has been depreciated, the carrying amount of the building is only 18 million. Okay, carrying amount of the building is only 18 million. And very good, Satakshi, that's absolutely right. 18 million. Now what we are telling, we're saying that, think about it. 18 million was the value. And now we're seeing that the building's value has gone up. Right? The property costed 30 million. From 30 million, the value of the building has jumped to 60 million. So there's a jump in the value of the building property by 60 million. Yes, I know out of that, 6 million is for land. 6 million is for land. Here, 50 million is for land. So basically, out of 30 million, if 6 million was for land, 24 million was for building. Original value of the building was 24 million. And now the value of the building is 35 million. Sorry, 30 million. 60 minus 15. 45 million. So the new value of the building is 45 million. Are you understanding? The new value of the building is 45 million. Right? Because it went from being valued at how much originally the building was valued at. Look here, originally the building was valued at 24 million. From 30 million, if you deduct 6, 24 million. Now the building is valued at 45 million. So the building's value now is 45 million. Right? So the revaluation, the building is revalued to how much? 45 million. So think about it, from 18 million, it is now valued to 45 million. So how much will be the gain because of revaluation? From 18 million, if it has jumped to 45 million, how much is the gain? Who can tell me? 27 million. So the revaluation gain is 27 million for building. 27 million. So we have the revaluation gain for the building. Right? So we know what is the revaluation gain. Right? And you want to know what is the depreciation now, this year, in the new year. Remember, the building is now having a value of 45 million. And we saw that once the building has been revalued, the depreciation will be charged on the new value. So the building has a useful life of 40 years, out of which 10 years are over. So the remaining life is only 30 years. So think about it, the yearly depreciation will be 45 million divided by 30. How much will the yearly depreciation be? Yearly depreciation will be 1.5 million. So we have one of the answers that will go into, remember, I'm putting it in red. Red means it is something that we are losing. It's an expense. Are you understanding? Right? It's an expense. And remember, for a building, there's a revaluation gain. Anything that is in green, I'll let it be like a gain. This is a gain, 27 million. And in case of land, the gain is 9 million. So whatever is the gain, I'm putting it in green. So your gain is also something that will go to P&L. Any income and expense will go to P&L. So whatever is in green is a gain. Whatever is in red is an expense and therefore will land on the P&L. So I hope just have a look at this much of the screen and tell me if there's any problem anywhere. Now, what am I going to do? Going back over here down. Think about it. At the end of the year, yes, we have revalued the building to 45 million. Yes, we will depreciate it for 30 years. Yes, the yearly depreciation is 1,500,000. So at the end of the year, what will be the carrying amount of this building after revaluation? 45 million, we have again carrying amount I'm putting in purple. So what will be the carrying amount from 45 million if 1,500,000 is depreciated? What will be the carrying amount? 43. Again, I need the answers fast. $43,500,000 will be the carrying amount. And remember, this figures go in the statement of financial position. Very good, Satakshi. Very good, Samantha. This will go in the statement of financial position, and same way for land. For land, you revalued the land to 15 million. There is no depreciation, remember. So this amount will be the carrying amount of land. Carrying amount, you revalued it to 15 million. And because there is no depreciation, this will be the carrying amount. So whatever is in purple is the carrying amount and will find its place in the statement of financial position under non-current assets. I repeat, whatever is in red is an expense. It will go to P&L. Whatever is in green is an income. It's a gain. It will go to P&L. And expense and income both go to P&L. Whatever is in purple is the carrying value of the asset, the latest carrying amount of the asset, and definitely it needs to be reflected in the value of the asset in the statement of financial position. Okay. And after that, what is the revaluation surplus? What do you think is the revaluation surplus? Again, I'll calculate that, don't worry. But as of now, think about it. This is a surplus. This is a surplus. So the revaluation surplus will be surplus is 27 million plus 9 million. So the revaluation surplus is 36 million. And this I am putting in orange. 36 million is the revaluation surplus. Okay. $36 million. But look at the question. It says that the entity's policy is to make an annual transfer of realized amounts to retained earnings. Annual transfer of realized amounts to retained earnings. What do I mean by this? I will come to shortly. But first, I will complete this much of the question. Again, guys, whatever is in green is an income and will go to the statement of profit or loss. Whatever is in red is an expense and will go to the statement of profit or loss. Whatever is in purple is basically the latest carrying amount of the asset and will go to the statement of statement of financial position under non-current asset. Okay, and of course, Under equity heading, we will show revaluation surplus, right? So can we, using this pieces of information, can we show the extracts? I'll do it over here on the right hand side. Okay. Statement of financial position. Which ones will we take? The purple ones, the carrying amounts under non-current assets. How much is it? 43,500,000 plus 15 million. How much will the value of the non-current asset be now? 43 million plus 500,000. How much? 58,500,000. Very good, Saman. 58,500,000. As simple as that. Statement of financial position over. Yes, there is revaluation surplus, but I said we will come back to it. Can we look at statement of profit or loss? I told you, statement of profit or loss, both income and expenses will be recorded. That's why I'm putting statement of profit or loss in both green and red, because little bit is profit, little bit is loss. I told you everything in red is an expense and will go to P&L. Everything in green is an income and will go to P&L. Therefore, in the statement of profit or loss, you will take everything in green, which is at 9 million, 27 million, right? So 9 million plus 27 million is 36 million. So this will be in green because this is the revaluation gain. 9 plus 27 is 36 million. And what will be in red? The expense. The expense is of depreciation, 1,500,000. This is an expense. This is costing us. Therefore, I put it in 1,500,000. This is the statement of profit or loss. So I hope there is absolutely no problem in the statement of financial position and the statement of profit or loss. Moving on further, we're now looking at the third financial statement, which is the statement of changes in equity. And I told you before also, the revaluation surplus will go to change statement of changes in equity. Right? Anything that belongs to the owners is equity. And remember, any surplus, any extra value to the asset, ultimately, who is the owner? The owner. Who does it belong to? It belongs to the owner. So the revaluation surplus needs to go under the heading of equity. Both in the statement of financial position also there is a mention of equity, and obviously in the statement of changes in equity also there's a mention of equity. But there's a small calculation there which I will come to shortly. Just see if this much of the question is clear. I'll give you 2 minutes. Any problems, guys? Is this much part of the question clear? This is actually 98% of the question is over. There's only a small percentage of the question left. Is it clear, yes or no? Satakshi, Samantha, Kenny, Nityashri. Yes. Now what we will do is, again, 6:55, again, as per the scheduled time. (6:55) is the scheduled break, and we have to stick to those timings very strictly. So You don't need to leave the meeting, stay in the meeting, but we will continue at 7:05. Yes, guys, come back. Let me know that you're here. Just type it in the chat box so I know. Just let me know in the chat box that you're present. Quickly. Okay. Let us continue where we're going to look at this question. We were on test your understanding 3. The only thing that was left was the statement of changes in equity. Okay, and when we do look at statement of changes in equity, the thing that you need to pay attention to is this sentence. The policy is to make an annual transfer of released amounts to retained earnings. What do I mean by that? Sorry, not released amounts, realized amounts. How much was the depreciation before the revaluation? Remember, before, old story, the property was valued at 30 million, out of which 6 million was for land. So obviously land will not depreciate, only building will depreciate. And we said that the life was 40 years. So originally the old depreciation was 24 million divided by 40. So 24 divided by 40 is how much? How much was the old depreciation? The old depreciation again was 24 divided by 40, 600,000. Old depreciation. What about the new depreciation? Can somebody confirm it's 600,000? This one? Now again, I'll wait for like 4 minutes for one person to respond. Just confirm. New depreciation is what? New depreciation is going to be, again, we calculated the new depreciation here. The new depreciation is 1.5 million. Therefore, what's the difference between the new and the old depreciation? What is the difference between the new and the old depreciation? How much? Quickly, please tell me. What is the difference? Old depreciation is 600, new depreciation is 1.5 million. What is the difference between the two? 45. How come 45? 600,000 minus 1.5 million is how much? How much is it? On top of this, you want notes also. Basic calculation you're not doing. What is the difference between 1.5 million and 600,000? is 1,500,000 minus 600,000. It's 900,000. This 900,000 is the difference. So you will say that the realized amount, this amount of 140, this amount of 900,000 will be subject to an annual transfer. Why? Because here, if you see, an annual reserves transfer may be made from revaluation surplus to retained earnings for the additional depreciation charged on the revalued amount. See, on the revalued amount, the new depreciation is 1.5 and the old depreciation was 600. So the additional depreciation charge is 900,000, and this 900,000, again, we can make a transfer from revaluation surplus to retained earnings, which is, as a rule, you may choose to do this. So from revaluation surplus, you will remove it from revaluation surplus and put it in retained earnings. That is why in the revaluation surplus, what we have is, in the revaluation surplus from 36 million, we are making a transfer to retained earnings of this additional 900,000. So we are removing it from revaluation surplus and transferring it to retained earnings. So the revaluation surplus balance becomes, again, I don't want to ask you to do the calculation. Thank you for the efforts. But the revaluation surplus will be 35,100,000. And the same thing will be reflected over here. Statement of changes in equity. Again, under statement of changes in equity, equity is everything that belongs to the owners. And revaluation surplus is also something that belongs to the owners. And the revaluation surplus will be this much. Again, because 900,000, we chose to do a transfer, with which this question is over. Okay. Now, this question is done. All the information of this question is here. Old depreciation was how much? 600,000. New depreciation is 1.5 million. So the difference is 900,000. The difference is 900,000. This additional depreciation, see, I've highlighted in the text. Look at the left-hand side. It can be subject to an annual transfer amount. So the annual transfer is made from the revaluation surplus to retained earnings, and this amount is 900,000. That is why we are removing it from revaluation surplus and putting it in retained earnings. So everything is there on the screen. Is this clear? Test your understanding 3. Is this clear? Itanshu, Kenny, Nityashri, Teerth. Next, we will look at test your understanding 4. Derek purchased a property costing 750,000 on 1st Jan 2024 with a useful life of 10 years. It has no residual value. At 31st December 2024, the property was valued at 810,000, resulting in a gain on revaluation being recorded in other comprehensive income of 135,000. There was no change to its useful life. Derek does not make a transfer to realized profits in respect of excess depreciation. So this guy does not make that transfer. So remember that transfer, you may make it or you may not make it. It's a choice. But Derek does not make the transfer. So you don't need to deduct the excess depreciation from the revaluation surplus. So in this case, how do you go about it? Remember, again, we sold the property for 900,000. We want to know how should the disposal on the previously revalued asset be treated. So again, the sale was, we sold the property for 900,000. Now we have to look at what was the carrying value of the property when we sold it. Okay. What was the carrying value of the property when you sold the property? Again, you need to know that you originally bought it for 750,000 and there was a life of 10 years. It has no residual value at 31st December. That is, after 1 year, the property was revalued to 800. Okay, so there is no need to worry about the old depreciation. The new value was 810,000 in a gain on revaluation being recorded in other comprehensive income of 135,000. So there was a gain of revaluation on 135,000. Now, there was no change to its useful life. And after 2 years, I sold this property. See, I bought it. I mean, the property was revalued on 31st December 2004, and I sold it on 31st December 2026. You understand? And out of 10 years, 1 year is already over. Remember, Jan 1st, 2024 to December 31st, 2024, 1 year completed. So only 9 years left. Right? So obviously, if it is revalued to 810,000, it will be depreciated for how many years? 9 years. So 810,000 divided by 9 is how much? How much will be the yearly depreciation? Per year, every year depreciation is how much? Who can calculate and tell me? 810,000 divided by 9, yearly depreciation is 90,000. And remember, this was in 2024 and we sold the property in 2026. So if 90,000 is the yearly depreciation, if 90,000 is the yearly depreciation, 2025, 2026, 2-year depreciation will be 90,000 into 2, which is 180,000. So we got the 2-year depreciation. 2-year depreciation is 180,000. And if you buy the property for say 810,000, you didn't buy it for 810, but the value was 810. So the revalued amount was 810, and from 810, the 2-year depreciation is 180,000. So what will be the carrying amount of the property at the end of 2 years? 810. There was a depreciation of 180,000. So 810 minus 180,000 is how much? Who can tell me? The simple calculation. Are you there? Niteshri, Kenny, Tanshu, Tirth. How much is the calculation? Amount is 810. Depreciation is 180,000. So what is the carrying amount? 810. There's a wear and tear of 180. So what is the remaining balance amount? Can anybody calculate and tell me? 800, Kenny, 90, what is that? 90,000. 810 minus 180. 630,000. So if the carrying amount is 630,000, I don't understand. Like if you are understanding, carrying amount is you sold the property for 900,000. So can anybody try to do this subtraction and tell me what would the profit be? Value of the property is 630. Sale is 900. So what is the profit? 900,000, you sell some pen. Say, for example, you sold a pen for 10 rupees and you bought it for 6 rupees. How much is the profit? How much? 900,000 minus 630. It is 270,000. Right? So that is the answer. So the profit is 270,000. Test your understanding. That is it. We will now go to grants. What is a grant? A grant is basically like an amount of money the government gives you for something, could be for anything, for something could be for anything, right? So how do you treat grants in financial reporting? How do you show a grant in the financial statements, right? That is what you have to look at in this specific topic. How do you treat grants? What do you do with grants? Right? So grants, again, are money which the government might give you. This could be to probably support you in your business. Right? This could be for what? This could be to support you in your business. And now, government grants, that is, say, government gives you money. Government could give you money for two reasons. Reason one, reason two. What are the two reasons? The two reasons are, number one, the government could give you grant for your expenses. Oh, okay, you pay your electricity bill, you pay your rent. This grant is known as a revenue grant. Or government could give you grant to buy some assets, say to buy non-current assets. This type of grant is known as capital grant. So there are two types of grants that you need to be aware of: revenue grant and capital grant. What is a revenue grant? Revenue grant is a grant or is money given to you for your expenses. Versus capital grant is money that is given to you to buy non-current assets. You understand? So you have revenue grants and capital grants. Right? Now, there are two principles that you should be aware of. The two principles are prudence and accruals. Right? What is prudence and accruals? Accrual is what? And prudence is what? Now, prudence means this. Suppose I tell you that if you get 95%, your boss will get you a bonus of 4 lakhs, suppose. So this is if you get 95% in your FR exam, your boss will give you a bonus of 4 lakhs. So the question is, will you start celebrating already? Will you already start celebrating? Will you already start enjoying? Oh, I will get 4 lakh rupees. Will you start jumping? No, because you did not get 4 lakh rupees yet. You understand? So basically, don't celebrate too early, right? So prudence means you need to be careful. Don't underestimate expenses. Expenses, number one. Don't underestimate them. Don't overestimate income. What do I mean by don't underestimate expenses and don't overestimate income? Don't underestimate expenses means maybe you will have to spend more money on something. So when you go out, for example, you keep extra cash. For example, you are being careful, and that is what prudence means. And with respect to, again, when it respect to grants, do not start celebrating a grant. Grant is what? Money given to you by the government. Do not start celebrating a grant until and unless what? Until and unless you are sure that you will get it. There is reasonable assurance or confidence that you will get the grant. Don't celebrate it before that. You understand? So, what is prudence? Prudence basically says that a grant cannot be celebrated or recognized until and unless you are sure that you will receive it. And when will you receive it? You will receive it once you fulfill all the conditions. When will you receive this 1.4 lakh rupees? When you fulfill the conditions of getting 95%. Right? So, again, grant should not be recognized until and unless you are sure you will receive it. You will receive it when the conditions that the government keeps have been fulfilled by you. Maybe the government will tell you that, okay, this many students, poor students, you need to help. Then you will get a grant. Right? So you need to fulfill the conditions that the government keeps. Only then you will receive the grant, and you will recognize the grant in your, where will you recognize it? In your financial statements. You will write it down in your financial statements only when you are 100% sure that you will receive it. And you will receive it when you fulfill the conditions of receiving the grant. Without which you will not recognize a grant in the financial statements. Right? So that is prudence. Prudence, what does it say? I'm going to highlight it. Prudence basically says, with respect to grants, what prudence says is you need to be careful. You will only recognize grants. I'm going to put that in blue. You will only recognize grants when you are sure that you will receive it, until which you will not recognize grants. And when will you receive a grant? You will receive a grant when the conditions have been fulfilled. Right? This is what prudence talks about. So we've looked at prudence. Now we will look at accruals. What do we mean by accruals? Again, accruals says that whenever you get a grant, grants should be matched and mapped with which the expenditure towards which they were intended to contribute. What do I mean by this is, suppose Mark gives you 50,000 as a grant. Mark gives you this money, 50,000 rupees Mark gives you. And he tells you, this is for your travel. So you're going somewhere and Mark gives you 50,000 for travel. So your food expense is 1 lakh. Your travel expense is 1.5 lakh. Your accommodation is 2 lakhs. This grant, no, this isn't really a grant. This is given to you by an individual. But this money, you will properly match it with the expense for which it was given, and it was given for travel. So you will deduct this 50,000 from your travel expense, not from anywhere else. Right? Accruals, the grant is given to you for a certain expense, for example. That amount should be matched to the expense for which it was given, not for anything else. See, that is what accruals is. Okay, so accruals basically says that the amount, the grant amount should be matched with the intended expenditure for which it was given in the first place. First place. This is what accruals tells you. So accruals is done and prudence is done also. Right? So prudence and accruals completed. Now we're going to look at the two types of grants in more detail. We're going to look at revenue grants and we're going to look at capital grants. But as of now, first things first, we're going to look at revenue grants. What do I mean by revenue grants? I did mention this earlier. Remove this. But I did mention this earlier. What is a revenue grant? Revenue grant is the grant that is given to you for certain expenses, not to buy a machine, not to buy a land, not to buy a building. It is given to you, say, for paying your staff. It is given to you, say, for paying your EB bill, electricity bill. It was given to you, say, for example, to pay your expenses, basically. That kind of grant is a revenue grant. And we had looked at this here. I said grant, two types. But now we're going to look at revenue grants in more detail. What is a revenue grant? Right? Again, this is a grant given, go back. given to be paid against certain expenses. Scroll down. Now, if how will you recognize? The recognition of grant will depend on the circumstances. How will you recognize a grant? How will you say that, okay, this can now enter my financial statements by the name of grant? How will you and when will you recognize something as a grant? When will you recognize something as a grant? The grant could be paid upon different circumstances. Say, for example, maybe the grant is paid when you prove, grant is paid when there is proof that you have a certain expense. For example, the government tells you that if you have an expense of, say, what, you have an expense of running a big workshop. When there is proof that this workshop has happened, then we will pay the grant. The government can tell you that. So one case is where the grant could be paid, the condition to pay the grant could be to receive the grant could be that the grant will be paid when there is proof that there was this specific expenditure incurred. Okay? That if that happens, then yes, you will recognize the grant and the grant received. You will recognize the grant now. Once you have proof, you can go to the government and say, look, we have the proof and this grant, you can now finally recognize which you receive from the government. You recognize it as a grant. And as I said, you have to follow the accruals concept. What did I say accruals was? The grant amount should be matched with the intended expenditure. It needs to be deducted from that specific expenditure. For example, if the grant is given for a specific workshop, then that amount that you receive from the government needs to be deducted for that workshop. So you recognize it as a grant and follow the accruals concept. What is accruals concept? I repeat, the grant amount that is received should be properly matched and deducted against the expenditure for which it was given, not for anything else. And the example for this is here. That is, guys, a revenue grant. Sorry, that is the first criteria, or that is the first way you would recognize a grant. The other condition, the government could also keep a condition that to pay a grant could be that you need to achieve something. Say, for example, the government tells me that I'll give you a grant if you make 15 students pass. So I will have to make those 15 students pass, and the grant has to be matched with the cost of making those 15 students pass. Right? So basically, to recognize grant, either the grant could be given to you for a specific expense. If the grant is given to you for a specific expense, then basically, once that expense has been incurred, you will match that amount of grant for that specific expense. Basically, follow the accruals concept. Basically, you will deduct that amount received from that specific expense. Or sometimes a grant could be given in the condition that you achieve certain objectives, like maybe making 15 students pass. If that is the condition, then when I get a grant, I will deduct it against the cost of making those 15 students clear. Okay, so that is about revenue grants. That is the brief intro of revenue grants. Right? Now, what is the next thing we are looking at? We're looking at one is recognition, but how will you show it in the financial statements? How will you treat it in the financial statements? So, presentation of revenue grants. What do I mean by presentation of revenue grants? It's very, very simple, but grant is money received, correct? Suppose I give you, or say your father gives you money for snacks. You are going on a trip. Either you say he gives you 5,000. So either you add that 5,000 as an income and say, wow, I have received 5,000. This is treated as an income. You're saying I have received it. So either you treat it as an income or you treat it as a reduction in cost. What do I mean by you treat it as a reduction in cost? You've got 5,000, you know for snacks, you will spend 10,000. So the other way of treating this 5,000 is simply deduct it from an expense, bringing down the expense. So either you treat it as an income, where the grant is presented as a credit in the statement of profit or loss, or you just deduct it from the related income. Both these ways of presentation of grants are allowed by IAS 20. So when it comes to presentation of grants, IAS 20 has a rule and it tells you that there are two ways to present a grant. Either you can treat it as an income or you can treat it as something that reduces the specific cost. As per IAS 20, you can treat a grant in both ways. Either you treat it as an income or you treat it as something that is minimizing your cost. For example, if in my office, I decide to put up a CBE center, and through that center, suppose I earn 50,000. Either I can treat that 50,000 as an earning, either I can treat that 50,000 as an earning, or what I will do is I will say my rent is 60,000. So by having a CBE center, I am earning 50,000, because of which my rent is 60,000. I earn 50,000 from the CBE center. So you bring down the rent and say, because of that, I say that my rent is only 10,000. Both are allowed. I can either treat that 50,000 as an earning, or I can use that 50,000 to bring down a certain related expense. Both are allowed by IAS 20. I hope that's clear. Now we will look at capital grants. Guys, so far clear everything? Just let me know. Quickly, Kenny, Nityashri, Tir. Okay. Moving on to something known as capital grants. What are capital grants? Again, capital grant is basically when you receive money from the government in order to get a non-current asset, for example. Right? So a capital grant is basically a grant when you receive money from the government in order to get a non-current asset. That is a capital grant. And there are two ways of treating a capital grant. Two ways. What are the two ways of treating a capital grant? And IS 20 says that again, either you can reduce it from the cost of the asset. For example, the government gives you 80,000. First way is scenario. The government gives you 80,000 to buy a car. The car costs 10 lakhs. What you will do, the first way to treat a capital grant is where from that 10 lakh, you will simply deduct 80,000. So 10 lakh minus 80,000 is 9 lakh 20,000. This you will say is the value of your the car, and now you will depreciate this 9.2 lakhs. So the first way, as per IAS 20, the first way to treat a capital grant is where you will deduct the grant amount received from the value or from the cost of the asset. The remaining amount will be depreciated as usual. Okay, so that is your capital grant. The second way of treating a capital grant is where you treat the grant as a deferred credit and transfer a portion to, okay, this we will look at in the sums. When we do a numerical, we will try to understand what this means. Okay, so now we're going to look at test your understanding 5. Look at the question. The question says that a capital grant, an entity opens a new factory and receives a government grant of 15,000 in respect of capital equipment costing 100,000. It depreciates all plant and machinery at 20% per annum straight line. Show the extract, statement of profit or loss, and statement of financial position extract in respect of the grant in the first year under both methods. So again, the first method is easy, where you are simply deducting it from the cost of the asset and you are depreciating the asset as usual. How much does the machine cost? The machine costs 100,000. The machine costs what? It costs 100,000. And you are receiving a grant of 15,000. So the first way is, as I mentioned in my example, you can simply deduct the grant received from the cost of the asset. So the grant received is how much? 15,000. Right? So what will you do? From 100,000, you will deduct the grant received and you will value the non-current asset. You will say the plant and machinery, you will value it at, directly you will value it at 85,000. So basically it's like the machine came to you for a little lesser. It's like you got a small discount on that 15,000. It's actually costing you 15,000, 100,000. But because the government gave you a grant of 15,000, you are deducting that from the cost of the asset, almost like a discount. And now you are saying that the plant and machinery is worth 85,000. Right? After which you will depreciate the asset as usual. You will depreciate at 20% per annum. So if the value of the asset is 85%, the depreciation charge per annum will be 20% of 85,000. So 20% of 85,000 is 17,000. This is first year's depreciation. So the value or the carrying amount of the asset becomes 85,000 minus 17,000. It becomes 68,000. Right? That's it. Carrying amount is what? 68,000. So that is the first method, method one. What would be the second method? Now, the second method is what people generally get confused with. Method one is very simple. You are simply treating the grant like a discount. From 100,000, 15,000 is a discount. So the plant and machinery is valued at 85,000. Depreciation is 17,000. So carrying amount is 68,000. That is the first method. The second method is what? The second method is basically where, go back, I told you I'll come back. Treat the grant as an income and transfer a portion of it to revenue every year. I repeat, treat the grant as an income and transfer a part of it to revenue every year. What do I mean by this? This is simple. Again, for now, the method 2 will say we will take the full cost of the asset. Full cost of the asset is 100,000. You will depreciate normally as usual. Depreciation straight line method is 20% of 100,000 is 20,000, and you will say the carrying amount of the asset is 80,000. Right? As simple as that. Then what you do is basically the grant that you got. How much grant did you get? The amount of grant received was 15,000. Right? It is given again. This grant opens a new factory and receives a grant the first year. So again, think about it. If 15,000 is given to you, okay, and think about it, the machine is depreciating at 20% per year. 20% in the first year, 20% in the second year, 20% in the third year, 20% in the fourth year, 20% in the fifth year. So basically, after 5 years, it will be completely depreciated, meaning that the life of the asset is 5 years. So what you will do is, yes, the grant is 15,000. It's like you are taking this 15,000 and keeping in your locker. Imagine this is your locker. You are safely keeping this 15,000 inside. And again, the life of the asset is how many years? 5 years. So every year you will use a small part of that 15,000 every year as an income. So 15,000 is kept in your locker for 5 years, and every year you will take a part of it outside. So 15,000, if it is kept in your locker for 5 years, every year you can take out 3,000. So in the first year, what you will do is you will take out 3,000 from the locker and you will treat it as a credit, as an income. Are you understanding? So in year one, this 15,000 is treated as an income. So you will credit it. Government grant credit. It's like every year you're getting a part of that 15,000. It's not like in the first year itself you're using it. No, 15,000 you took from the government and you put it in your locker. Every year you will take a small amount of that outside. Equal amount. So 15,000 divided by 5. Every year you will take 3,000 as a credit, as an income. That is the second way of treating a grant, and that is what I meant by saying treat the grant as a deferred income. What do I mean by deferred credit? You will not get everything this year. You will get it later, a little bit. See, out of 15,000, 3,000 you are getting this year. 3,000 out of 15,000 you got this year. The remaining 9,000 is still there in your locker. The remaining 9,000 after 15,000, if you take out 3,000 from the locker, 9,000 is still there, and that is not used this year. It will be used next year. So that is why only 3,000 is taken as this year's credit. The remaining will be used next year. And that is how you treat a capital grant, the second method of treating a capital grant. Right? So the second method of treating a capital grant was what? Again, taking out a portion of the grant each year. You will not use everything as an income. Just a portion of it you will take out every year. And you will treat it as a credit. So from 15,000, we know the life of the asset is 5 years. So each year, 3,000 per year, you will treat it as an income or credit. The remaining 9,000 is something that you will use later. So the remaining 9,000 is like you have kept it with you in your cupboard, but it belongs to what? It is something that you haven't recognized as an income yet. You understand? So it will fall in non-current liability, the remaining 9,000, because you will use it later. It will come later. As of now, you are treating it as government's money. So anyway, you don't need to worry about this. For now, all you need to know is a portion, basically whatever grant you receive, you will take it, and every year you will take out a percentage of it and use it. You will credit a percentage of that amount. And that is what, test your understanding, 5 says. Right? Now comes the repayment of debts. What do I mean by the repayment of grants? It's like this. If grants are conditional, right? If you do this, I will give you the grant. Government will be like, if you meet this condition, if you meet so and so condition, we will give you the grant. If at all that condition is not fulfilled, if you don't fulfill that condition, the grant has to be repaid. If you don't fulfill that condition, the grant has to be repaid. And that is why I said in this example that out of 15,000 which you have taken, you will keep it in your locker and only a percentage of it you will use every year. Out of 15,000, the life is 5 years. So you will only use 3,000 per year, 3, 6, 9, 12, 15. 3,000 only you will use per year. The remaining 9,000, I said you will treat it as a non-current liability, because if there is any breach, if there is any condition is breached or you don't fulfill a condition, it will have to be repaid. And that is why we've seen it here that if the capital grants method has been used, look at what is underlined. The remaining grant could be repaid to the government, and that is why the remaining amount is treated as a liability. So what does this say? This topic is simply saying that grants are mostly conditional. If you meet the conditions, we will give you the grant. If you don't, the grant has to be repaid. Right? And that is what we have looked at in repayment of grants topic. This is done today on 25th of March. Repayment of grants. Next thing we're going to look at is borrowing costs. What do I mean by borrowing costs? You want money, but you don't have it. You can borrow it. From where? From the government. Sorry, from the bank. But bank will give you money, no problem. But the bank will charge what? The bank will charge something known as interest. Suppose you borrow 50,000, bank will say, okay, I'm giving you 50,000, but you must return this 50,000 along with interest of 20%. So you will repay 50,000 plus 20% of 50,000. 20% of 50,000 is 10,000. So you will repay 60,000. This 60,000 you are paying extra. Sorry, this 10,000 you are paying extra. To who? To the bank. It is a cost for you of borrowing, and that is the borrowing cost. When you borrow money, not only will you repay the borrowed amount, but you will also pay interest. That interest that you pay when you borrow money is what? Is borrowing cost. As simple as that. That's it. Very, very simple. Very, very easy. Right? So when you repay an amount, along with that, you will pay to the bank interest. That is a cost for you. That cost is the cost because you are borrowing. And that is why the name is borrowing cost. And again, IAS 23 tells you how and what. It's basically helping you with borrowing costs. Remember, I told you even in the first class, IAS will come and help you in each and every step of the way. Here it is IAS 23. IAS 23 helps you with borrowing cost. Right? So here what is happening? Here we're basically looking at this. When we did recognition of an asset, I told you that you will also capitalize borrowing cost. I didn't mention this. Whoever has missed this part should definitely watch the previous recording. I mentioned this. We looked at what? Again, we looked at under measurement, PPE, we looked at the fact that borrowing cost has to be capitalized as value of the asset. Right? So what are the costs? The costs that will be capitalized. Now this is in a non-current asset. This goes back to a previous class. Again, cost of purchase. Number one, cost of borrowing. Number two, any cost of bringing the asset to usable condition. For example, installation, delivery, dismantling. Any costs of owning the asset. All these costs are to be capitalized. Right? All these costs are to be capitalized. And here, what are we looking at? We're looking at borrowing costs, which says that you will capitalize the borrowing cost. As simple as that. And let's look at what we will look at. Test your understanding 6 to understand commencement of capitalization and the rate of interest to be taken. And this is a very interesting, topic. Right? So how do you deal with test your understanding 6? Again, I think what I will do is I'll just mention on commencement of capitalization. See, when you borrow money, bank will charge interest per year. Per annum. This is the interest bank will charge every year. Correct? But suppose the interest is 18% per annum or per year, you will not capitalize that 18%. Again, the ones who haven't attended that capitalizing part, please watch that recording. You will start capitalizing on this 18% only when the expense for the asset has started. Expenditure or spending for the asset has started. What do I mean by this? For example, to build a house, you borrow from the bank. The bank gives you 10 lakh at 18% interest. So your interest is the borrowing cost. Okay. You borrowed on 1st Jan 2025. But the construction of the building only started on 3rd March. This cost is 18% for the year. It's for 12 months. But the construction only happened from March onwards. So first 2 months, when the construction was not happening, you will not capitalize. The first 2 months, when the construction was not happening, still you have to pay interest for the entire year, correct? But the first 2 months for which you paid interest, you cannot capitalize it because construction started only on March. So the first 2 months when the construction was not happening, the borrowing cost cannot be capitalized. It will be expensed. So in order to capitalize, in order to start capitalizing borrowing cost, you need to ensure that the expenditure for the asset has started. Right? Activities for the that are necessary to prepare the asset for its intended use are in progress. And the interest has started. So the borrowing cost is incurred. Obviously, only then you will capitalize it. Otherwise, how can you capitalize? Right? So these are some of the conditions to capitalize borrowing cost without the expense starting. For example, if you borrow money from the bank, this is the best example. To build a house, the bank charges an 18% interest for 12 months. But out of the 12 months, you started construction only after 2 months. So 2 months wasted. So you will start capitalizing only from when your construction started. Do you understand? Are we clear on this? not for the entire period. I hope this is comfortable and clear to everybody, right? And obviously the borrowing cost has to be incurred, right? And that is what you have over here, which is simply talking about IS 23. Yes, again, we saw borrowing cost. And now we looked at the commencement of capitalization. Okay. We have broadly completed major chunks of this chapter. This was a very big chapter. Chapter 3, 4, 5, 6, 7, 8, they're all not so big. Chapter 2 was reasonably big, right? So now what is pending is just investment property. That's it, with which chapter 2 is over. So I believe the next class, I mean, we've shared the timetable with you. So you need to know better now. But by the next class, chapter 2 will be over and I will start with chapter 3, which is intangible assets. So next class, in fact, I will even try to complete the third chapter because third chapter is very small. So I'll move to the fourth chapter in the next class and probably maybe even finish the fourth chapter. Yes, fourth chapter also can be completed in the next class. So again, second chapter took time because it was comparatively bigger, but third, fourth chapters I can complete in the next class itself. Right? So again, these are the things that we broadly looked at. Again, from time to time, I have been checking up on you, whether you are clear on your understanding. Nobody till now has raised any problem. But these are the 15 topics that we've looked at today. Right? So 20 topics in the previous class, in this specific class, 15 topics. They will be uploaded. We will be uploading shortly. Right? So again, we have completed these 15 things and it's 8, I mean, we are almost done, right? The class 8:20 and this is our timetable. So this is what we have completed. So these few minutes, 8:20 onwards, is time for you to review what we have done and put your understanding out of 5. Please go ahead. Review it. 10 minutes you have, not 10 minutes, I mean 10 minutes completely. Go through, see how much is your understanding and put your understanding out of 5. Yes, that's what I said, no? We will upload. So can you type your rating out of 5, each of you, for these things? Quickly. Hitanshu. We have Hitanshu here, Priyanshu. So Hitanshu, how much would you rate your understanding out of 5? Priyanshu. Whoever is here. Again, Hitanshu, which part is it 4 out of 5? Was it because you missed some topics because of your internet? Yes, please do. Again, see, the rating is for what you watched. For what you not watched, I mean, I can't help you. You have to go back and watch it. But something you've watched, but you didn't understand. Obviously, there is some issues somewhere. You have a certain understanding, but that understanding is not right. Or you really don't understand what is revenue ground, something like that. Right? So whenever I ask you your rating out of 5, it is for what you've seen and attended. So for what you attended, how much is it? Without disturbance for whatever you've attended. Okay, fine. That is all, guys. You can leave. Thank you so much.